Okay, move to the theories explaining why share price change. We just discussed about the efficient market hypothesis introduction. We just share with you how to get the numbers of the investors' return. It includes two parts. The first one is the dividend yield or the dividends, return from dividends. The other is the capital gains. So capital gains is from the price changes. So here we will talk about the price changes, the theories explaining the price changes, and also the efficient market hypothesis on the price change. The aim of the EMH is to attempt or explain how the market reacts about the share price movement to the relevant information. So here we talk about some keywords. The EMH is about the share price movement. It's about relevant information. So it's about the information or how the information impact the share price movements, or the other words. Okay, so it's the aim of the EMH. And in an efficient market, the rational investor will seek to invest and trade financial securities until they have maximized their wealth at an acceptable level of risk. Okay, so in an efficient market, so here's the basic assumption is efficient market. Another assumption is about the rational investor. All right. So in efficient market, rational investor, they will maximize their wealth and return at an acceptable level of risk. So we move on to talk about some theories explaining the price movement. The first theory we will talk about is the technical analysis. The technical analysis, okay, the first assumption is share prices follow a certain pattern which are repeatable. In other words, the technical analysis, those experts in technical analysis believe that the share price movement the share price movement is first has a cycle or trend. In other words, the share price movement will follow the cycle or a trend which is happened in the past. So second is repeatable. So the technical analysts, they believe that the share price can be forecast or predictable. The technical analysts, they have the assumption the share prices follow a certain patterns which are repeatable. In other words, the share price has a cycle or has a trend. For example, for every 10 years, the share price will, or the overall stock market will have a plunge. For example, drop by, say, 60%, just an example. It's the belief on the technical analysis. They have a cycle, there's a trend, and it is repeatable as well. So it is forecast, it can be forecast for the share price. And what we call those believers of the technical analysis are the chartists, because they would like to draw charts to explain the share prices. And these chartists belie the efficient market hypothesis by arguing that the share prices do not follow a random walk. What does it mean by random walk? The when we talk about share price at a random follow a random walk means it is not cannot be forecast. Cannot be forecast. No matter, for example, by the technical analysis, the share price is just at a randomly moved. You cannot forecast the share prices. So it's the EMH, efficient market hypothesis proposition. But the chartists deny that. So they believe the share price can be forecast. And the investor can make abnormal returns by studying how the share price moved in the past. So the theory suggests that profit taking is possible. So abnormal returns is possible from buying and selling of shares by closely observing the patterns of share prices movement. So they would like to draw charts to explain the share price moved. And here, I would like to show you one of the typical graphs of the chartist. Here, what we call is the head and shoulders. So on the x-axis is time, and on the y-axis is the share prices. So what does it mean by the head and shoulders? So the chartists believe that when the share price is going up, for example like that, it may have a small peak at first, and then maybe a drop afterwards. So is there another head again, and then drop? Okay, so let me explain what is the head and shoulders. Here is the graph showing the chartists believe that when the share price is going up on the left-hand side like this, it is going upward, right? It is going upward, the share price is going upward, and the investors would like to buy the shares when it is going upward. The psychological impact or the behavior showing that, okay, the stock will be going up, so they would like to take profit by buying it earlier. So just coming into the market to buy the shares until the stocks are overbought, say at this point, let's say X. So some correction on the prices, and then afterwards, the investors believe that the share prices will go up because maybe, for example, of the better outlook on the bright prospect of the company. So it will push up again on the share prices to another peak. Let's say Y. But at point Y, the share price is too high. The share price is too high, and the fundamentals may be, for example, deteriorated or has no change. So is the share price reflecting the stock is overvalued? Then the people would like to take profit, and share price drop, and also have some rebound. Upon that, all right. So, but for head and shoulders, okay, it's the trend. Okay, we need to look at the volume as well, the share turnover volume. Maybe initially the volume is going up as well. Here, I'll use a bar as the volume. All right, maybe just going up and up, and when the prices drop, initially it's going up the volume, but then it dropped the volume upon Z. So once the market forces, when more people would like to sell the shares, then the price plunge. Okay, so it's the typical graph of the chartist belief that when the share price performance is similar to this chart, they call it head and shoulders. Then, when, for example, when they upon that, when they see the price upon that, the share price upon that, they are better to sell instead of buy the shares because they believe that the share price will have a plunge afterwards. Because share price just follow the pattern, what they happened in the past. So when they study, for example, in the past, maybe it happened, the share price performance will be like that. So they just follow the same pattern in the future. All right. So here is one graph showing the technical or the chartist belief on the technical analysis. Just follow the pattern. And next, we move on to the fundamental analysis. The fundamental analysis is concerning the valuing of a business. Okay, valuing of a business. So it's the fundamental reading the company's financial statements, analyzing the ratios, talking about the company's cash flow, or the NPV projects. So all are the fundamental work because they would like to find the intrinsic value of a company. Okay, they will compare the intrinsic value and the market price. So they are looking for a bargain. Which means that for the fundamental analyst, they concern the fundamental factors of a company to value the business, to find the intrinsic value, and compare to the market price. Okay, if they find the intrinsic value is lower, or sorry, is higher than the market price, it means the company is worth to buy. So they just look for the bargain, and if they find it is cheaper in the market price, they buy it and just buy the shares of a company, and then to sit here to wait for the intrinsic value coming back to the market price level. So therefore, the market price will go up. For example, if the intrinsic value, they found the intrinsic value is say $5, the market price, say for example, is only $3. They will come to buy at $3 and wait for the company intrinsic value to be reflected in the market. So it's their belief. It's their belief. They finally believe that the share price finally will be moved to around the intrinsic value. So they just look for the bargain in the market. So they derive at a value for business shares by using some common models, for example, dividend valuation model or DCF model, discount cash flow analysis. Okay, when they have the adequate information released by the company or from other sources, so they can use the DCF analysis to evaluate the company's true value. And it says that all shares will have a basic value called intrinsic value. Okay, it's a keyword, intrinsic value, and that the market price of the shares will fluctuate up and down around this value, but the long run will be average at the intrinsic value. So they just found the shares which is undervalued at in the market. So they can buy it, and they believe in the long run they can make profits by holding those shares. Okay, so this theory argues that the profit taking from selling and buying of shares is not possible in the long run. So what the strategy of fundamental analysis? The strategy is buy and hold. Okay, we have different strategies for technical analysis. Or the chartists, they would like to selling and buying because the share price follow a pattern. So they just follow the pattern. When the price is going up, they just go into the market and buy the shares. When it follows the pattern and it seems the price will be plunged, so they sell the shares and make profit. But for fundamental analysts, they believe that if the profit taking, just say, for example, you just rush into the market to buy and then sell it, it is not possible to make profit in the long run because they are believer of the company share should be at intrinsic value. If it's not at the intrinsic value, if it is lower than intrinsic value, they will go into the market and buy the shares and buy and hold strategy to wait for the share price coming back to the intrinsic value. All right. So for these two analysis, what's their belief behind? What's their belief behind? First, they disagree. EMH. Okay, for the technical analysis, they believe the share price will be moving following a pattern, following a cycle. And for the fundamental analyst, what their belief is, the share prices should be at the intrinsic value, and in the long run, they just move around up and down around the intrinsic value. And for the fundamental analyst, because all the information gathered will be analyzed, and even the information is publicly released, but not all investors reacting to those informations. So they can find the bargain in the market. The conclusion for these two models is they are not agree. They don't agree on the EMH because they think that the public released information are not well analyzed by all investors, so they can make profits or beat the market by buying and selling the shares because they can find the true value, and the other people cannot find the true value, and the market price is not showing the true value that they can make profit. Is the belief of these two analyses.